Diversification is an investment strategy that involves spreading investments across various asset classes such as stocks, bonds, real estate, and commodities. Its purpose is to reduce the risk of an investment portfolio by diversifying across assets that respond differently to market conditions. Why is diversification important? Diversification is important because it helps reduce the overall risk of a portfolio by spreading investments across different types of assets. It reduces exposure to market risk, which is the possibility that the value of investments will decrease due to changes in market conditions, such as a recession or a stock market crash. Diversification also helps reduce the impact of individual investments on a portfolio, reducing the impact of poor-performing stocks. Finally, diversification can help maximize long-term returns by providing exposure to a range of assets that respond differently to market conditions. How to diversify your portfolio? Here are several strategies for diversifying your portfolio. Asset allocation. Asset allocation is the process of dividing your investments among different asset classes, such as stocks, bonds, real estate, and commodities. Each asset class responds differently to market conditions, so by investing in multiple asset classes, you can reduce the risk of your portfolio. For example, if the stock market crashes, your investments in bonds or real estate may still perform well, offsetting some of the losses. Geographic diversification. Investing in different countries or regions can help you reduce the risk of your portfolio by spreading your investments across a range of different economies that respond differently to market conditions. For example, if the U.S. stock market is performing poorly, you may have investments in Europe or Asia that perform better, providing a cushion to your portfolio. Industry diversification. Investing in a range of different industries, such as technology, finance, and healthcare, can help reduce the risk of your portfolio. Each industry may respond differently to market conditions, so by investing in multiple industries, you can reduce the impact of any single industry on your portfolio. For example, if the technology sector experiences a downturn, your investments in healthcare or finance may still perform well, offsetting some of the losses. 4. Sector diversification. Investing in different sectors, such as energy, consumer goods, and healthcare, can also help reduce the risk of your portfolio. By investing in multiple sectors, you can reduce the impact of any single sector on your portfolio. For example, if the energy sector experiences a downturn, your investments in consumer goods or healthcare may still perform well, offsetting some of the losses. 5. Active management. Regularly reviewing and adjusting your investments to maintain a well-diversified portfolio is crucial. This can involve adjusting your asset allocation, selling underperforming investments, and purchasing new investments to maintain a well-diversified portfolio. By actively managing your investments, you can ensure that your portfolio remains diversified and aligned with your investment goals and risk tolerance. Final thoughts: diversification is key to successful investing, helping reduce portfolio risk and maximize returns over the long term. By diversifying investments and regularly reviewing and adjusting your portfolio, you can minimize your risk and maximize your returns. However, keep in mind that diversification does not guarantee a profit or protect against loss. So it's important to work with a professional advisor and regularly monitor your investments to ensure they remain aligned with your investment goals and risk tolerance.